Hi, good evening, everyone. Thanks for joining. We're very excited for the next hour. Should be very enriching. I'm joined here. I'm Fabio Fischer, head of international equity distribution for XP here in New York. I'm joined here by my colleagues Alberto Bernal, a global strategist for XP, and Thiago Faveri. He's responsible for investments for XP Private USA. And our speaker, Rick Rieder. As most of you know, XP has been partnering up with the most important asset managers globally. We distribute today over 30 funds internationally, and no one better than BlackRock to present today. As most of you know, BlackRock is the largest asset manager in the world with over $6 trillion of assets under management. Has been in Brazil for the last 10 years out of its 30 years of existence, employs 16,000 people in 30 different countries around the world. And speaking for BlackRock today, we have the honor to have Rick Rieder, one of the most seasoned PMs in the firm. Rick is the CIO of Global Fixed Income and head of a global asset investment team in the multi-asset strategies group. Quick bio on Rick. Before joining BlackRock in 2009, he was the president and CEO of R3 Capital Partners. He served as vice chairman and member of the borrowing committee for the U.S. Treasury, and is currently a member of the Federal Reserve Bank of New York's Investment Advisory Committee on Financial Markets. He currently serves on Alphabet Google Investment Advisory Committee and the UBS Research Advisory Board. He was awarded the Global Unconstrained Fixed Income Manager of the Year 2015 by Institutional Investor. He was also nominated by the same magazine in 2014. And in 2013, Rick was inducted into the Fixed Income Analyst Society Fixed Income Hall of Fame. He earned a BBA degree in finance from Emory University in '83 and an MBA from the best business school, I'm biased, class of 04, Wharton School of University of Pennsylvania. Very honored. He's a member of the board of the Emory University and the business school as well, and the university's finance committee, and is the vice chairman of the investment committee. He founded and is the chairman of the business school's BBA investment fund and community financial literacy program. Finally, Rick is the leading portfolio manager of two of the flagship strategies for BlackRock, the Global Bond Income and Fixed Income Global Opportunities. Fixed Income Global Opportunities, by the way, was recently awarded the Golden Medal by Morningstar. So with further ado, I'm going to pass the word to Rick. And Rick, if you could start just quickly, would you mind sharing an overview about what you oversee at BlackRock, an overview of the capabilities of the firm, and also the key differentiators of being the largest asset manager in the world? Thanks again, Rick.
Great, thank you, and thank you all for having us. I'll start by saying BlackRock is we're largest asset manager in the world, managing over $6 trillion in assets, spanning everything from equities to fixed income bonds to money market funds, to iShares, our famous iShares ETF products, etc. My business, so I am responsible for about $2.3 trillion of those assets across fixed income, and then our global allocation team, which I'll talk about in a second. I also chair the firm's investment council across all our assets. So I tend to speak to a lot of the securities around the firm that we manage. So my business directly, though, is about 250 investment professionals. And one of the beauties of BlackRock is our reach across the globe. And when we manage assets from fixed income to stocks, we generally have operatives, research people, investment professionals in virtually all the regions we operate in. So we tend to be a firm that isn't necessarily biased as to any one asset class. And so from an asset manager point of view, from how I manage assets and I allocate across different asset classes, I'm not biased as to where we go. We try and find where the best opportunity is in the world is. to take advantage of for our clients. Maybe I'll mention a few of the funds that I run directly, as we talked about this Global Bond Income Fund, which is a great example of our capabilities in that it allows us to source where we think the best opportunities are in income in the world. And we operate in an environment today where the central banks are all moving interest rates to zero, or in some parts of the world like Japan and Europe, rates moving to negative yields. So clients have found our Global Bond Income Fund to be very attractive because it gives them income in different markets. Another one I run is our Fixed Income Global Opportunities, which is a total return oriented, trying to find the best opportunity to create return for clients. And yet, literally yesterday, we were awarded the gold medal by Morningstar, which is a very prestigious award in terms of what they describe as best managed, risk managed funds in the industry. And anyway, so that fund allows us to take advantage of opportunities where we see the best fixed income assets, and we use a little bit of equities when we want to try and get some what I call beta into the portfolio, or some upside return in the portfolio. So that's our Fixed Income Global Opportunities. And the one I took over about a year ago, which I'm very, very excited about, is one called the Global Allocation Fund, which is it's BlackRock Global Allocation, which is generally an equity oriented. It's about 60% equities, 40% bonds, and we also hold positions in gold. And it gives us great flexibility to find stocks or bonds around the world. And we are super excited about that fund. Has had top 10% performance across the whole industry this year, through last year, and in the last 3 years, we're very close to the top 10% as well. So we're excited about that. So anyway, to summarize that, the beauty of BlackRock is it's a firm that can look at assets all over the world, find where the best opportunity is, and that's actually what I'm going to talk about today in this presentation, where today we see the best opportunity in the world to invest across asset classes. So without delay, maybe I'll get into the presentation if that's okay, and then we'll pause and we'll do questions after that. So you should see it on your screen, and I did this presentation a couple of weeks ago where I put it together a couple of weeks ago, and I'm going to talk about within it how things have changed as well. And I call it Wall Street's Believe It or Not, in that this was the most extraordinary. I've been doing this for 33 years, and this was the most extraordinary period of time that I've ever been involved with. And people ask, talk about the financial crisis and talk about when 9/11, 2001 came, and how is this different or the same? And this was unique, and quite frankly, I've never seen anything like an environment where it came on, the volatility in the markets, the risk in the markets came on so fast, and because of the coronavirus, that the markets became dislocated so quickly. And more like when we in 9/11, 2001, where it happened so quickly, and then there was great uncertainty afterwards. Whereas in the financial crisis in 2008, you knew things were starting to become more volatile. You knew you'd be in for years of the financial system having to change and restructure. But this is what's so hard about this event, is that it came on so quickly. Nobody has ever seen anything like this in terms of how fast, and then it's so unpredictable on the other side of it, to understand when do economies open up around the world, when does China open up, when does Europe open up, or parts of Europe, when does Italy open up, and obviously Brazil and other countries, and trying to anticipate that. And when the economies come back to some sense of normalcy is the most unusual thing I've ever been around. And anyway, I'll talk a little bit about that through the presentation. So if you go to the next page, just to describe some of this, I use a lot of charts, and I'll and hopefully you could see these, and I'll try and describe what I'm saying through these charts. The first is on the upper left, that I use a lot of the U.S. markets, but the Standard & Poor's 500 on the upper left had its fastest 30% decline from the high in 26 days than it's ever had. I don't know if you could see that black line on the chart, but the Great Depression in the 1930s was not nearly as quick as this was, to show how fast this came on, and nobody's ever seen this in our lifetimes. Then if you look at the chart on the top middle, that this is the volatility of the stock market, to show that the volatility that happened was faster than anything anybody's ever seen in our lifetime. There was actually the chart I show on the top right is actually in 1987. It actually was a somewhat similar dynamic. We're trying to find in history anything comparable to this, but in 1987, it was obviously the market is 10 times bigger than it was back then, but that rate of descent that happened so quickly, somewhat similar. The other thing is, when you look at the chart on the bottom left, that oil prices were at $66 this year, and then went down. And when I put this together two weeks ago, it was at $19. And I don't know if y'all saw this a couple of days ago, but oil prices went to negative because of the cost of storage of oil became so expensive, and there's no room to put it because of the demand has come off so much. Anyway, who would have thought in our lifetime you would have seen $66 down to less than zero for the price of oil? Then on the bottom middle, when you look at the price of long treasury bonds, they had a 10-day move of 33 points. That again, nothing anybody's ever seen before. So anyway, just to try to put in perspective how extraordinarily volatile this was. When you look at the next page, just to go even a bit deeper than this, when you look at what I did on the upper left, is we looked at the chart that shows the stock market, the days in the last 1 month where the stock market was either up or down 4% in a day. And it just shows, going back to 1928, you've never seen anything like this. By the way, we're still experiencing it, even days like today, where the market, I think from top to bottom, it was up. I guess we were up 3%. It was probably another 3.5% move. And then if you look at on the bottom left, the rolling price change of the stock market, pretty incredible. In the upper right, this is the movement. We only have data on bonds going back to 1993, so 27 years ago. But look at how interest rates have moved. The number of days that we've moved plus or minus 4% in a day this year. Nobody's ever seen anything like this. In the chart, if you just took the absolute value of that change, you see why my blood pressure is up so high, and it is and managing through this environment has been so difficult. And the headline I put on this page, it seems like we had more movement this year, and really in the last month and a half, than we did for the 10 years before. I mean, literally, which is, obviously we talk about, we manage a lot of money for clients, and trying to manage through this was, I think our portfolios came out pretty well, but it's been a really volatile period. I just want to talk about, not to get too technical, because I know there's people from different industries and backgrounds on this call, but what I did, and some of these, I sit on the Federal Reserve's advisory board, and I talk with them pretty regularly about things that are happening in the markets. And what I describe on this page is, the way structured assets or secured assets work is there's a AAA portion of these assets. So whether it's credit cards or auto loans or student loans, what are AAA rated, went through also an extraordinary point of volatility. And I remember talking to the Federal Reserve about this, going back 3 weeks ago, that when AAA, the highest rated assets in the world, cheapen up, come under so much pressure, then the whole system has a problem. And this is why we've seen the Federal Reserve in the U.S. has executed a series of initiatives to try and stabilize these markets, mostly starting with AAA assets. And they have. And what I put in those gray boxes, I don't know if you can see that.
Rick, just a second. Do you mind putting the page full in your screen so you can see the graphs? The audience can see the graph better.
I think that's as large as I can get it on my screen.
If you put a presentation mode.
Yeah, I think as I'm in PDF, I think it's hard to do that. I'll just talk through them.
Okay.
And,
Okay.
anyway, but the point being is, if you look on that in the gray box, and I'll talk through it, the credit cards, AAA credit cards, went from 400 spread to treasuries, and they've since come back to plus 70 basis points. So meaning that most of that incredible disruption has been fixed by the Federal Reserve, which is a really big deal for markets. Just to hit a couple other points, and then I want to talk about the broad economy. I'm going to skip markets, and then I'll come back to some of the things that I think are happening that are so extraordinary. I show. Let me just look on the top right. That triple B bond spreads. Triple A's had a problem. Triple B bond spreads even went crazier. And when you look at some of these levels, this takes some of the triple B. This is in the commercial mortgage space that went from 200 off to 1,500 off, and you never see that. Nobody's ever seen that in literally in history. And so this is part of why the Federal Reserve had to come to the equation and try and improve things. And then the last thing I will say, which I show on this next page, is the volatility of the markets. We can see this table, what I put on the left side. But things like the currencies, dollar yen, dollar Australia, dollar sterling, hit records of volatility that likes of which we've never seen before, and then the same thing with treasuries. And then obviously when you look on the bottom, I put Brazil in the Brazilian stock market, the Mexican stock market, literally 100% of the volatility we've seen in the last 10 years. So pretty spectacular things. So I'm going to skip a few pages because I want to talk about what it means for the economy and what's driving some of this. When you look on the next page I have on the screen, what you saw when this disruption took place is people just wanted to sell everything and go into cash. People were concerned personally about, I don't know how long I'm going to be out of work. People were concerned personally about their portfolios. And so you saw this tremendous selling of assets to go into cash. And so I show on these graphs what we were seeing in bond flows in terms of bonds. You can see on the top left, incredible movements. Just sell bonds, sell treasuries on the second graph, sell corporate bonds, sell high yield bonds, which is the most aggressive. Sell on the bottom left, emerging market bonds, sell equities. And then what we saw is just people going into cash, into money market funds, into bank deposit accounts. And that was, in this period of time was something that as I said, the Federal Reserve was really concerned about. And so now things have stabilized. And it's really important because money's starting to come back into the markets. And I'll talk about this at the end, that you can now start investing again. And one of the things we're doing is we're putting money, and I got asked by the Federal Reserve this today, are you investing in things like corporate bonds now? Are you investing in commercial mortgages? And we are. Which I think is a very big deal. So let's talk about the economy. And I apologize for how small some of these charts are, but what's driving the risk in the system? On the chart on the upper left, this is people seated diners at restaurants, meaning nobody's at a restaurant today, not surprisingly. And I show U.S. If you could see this, U.S. hotel occupancy rate, but that's fallen to next to nothing. I show on the upper right movie theaters, nobody going to movie theaters, and then on the bottom left, and this is something that's become extremely dangerous in the markets, is look at jobless claims on the bottom left. So by the way, when I did this chart, it was 4 million claims. That number's up to almost 20 million claims for unemployment, which is hard to believe. And just to put that number in perspective, the number of hires of people being employed since 2010, which was the greatest employment period that we've seen in 50, 60 years. There were 20 million people put to work, and we just lost 20 million. And we think by the end of May, we're probably going to lose 25 million people from the workforce. So it took 10 years to hire people, and then in literally 2 to 3 months, that you can have that many people out of work, which becomes very, very tricky from an investment point of view. And I was asked today by the Federal Reserve, what are you most focused on? And to me, it's that chart on the left. It's when are people going to start going back to work? And anyway, that is a really big deal for our economy. And then I put on the one of these charts on the bottom right, that GDP. We think that GDP, that growth is going to be negative 33% in the second quarter, negative 33% quarter over quarter growth. And then we think it's going to be plus something like 12% in the third quarter and plus 11 in the fourth quarter. So this incredible V of economic growth. But I'm going to skip a couple of pages because I want to talk about, well, maybe I'll talk about on this one page about people coming back to work, and I'll just talk about what's on this page. But there's something really important about jobs and hiring that's happened in the United States over the last 10 years. 100% of the jobs have come from three categories: professional services, so it's business outsourcing, business services, also education and healthcare, and leisure and hospitality. That's the third category. When we go and we look at the number of jobs and we think about what's going to happen from here, things like education and healthcare, we think they will come back. And I think, particularly healthcare, we think those will come back pretty quickly. However, the other side of the equation is leisure and hospitality, airlines, hotels, transportation generally. We think it's going to take a really long time. So the reason why this is so important is we think the unemployment rate in the U.S. is going to go to something like 15% next month, either this month or next month. And then we think as you get into the end of the year, it'll probably drop down to 7 or 8%. But 2 months ago, that number was 3.5%. The reason why that's important is the amount of fiscal stimulus and monetary stimulus that's going to come in is going to continue to be large going into next year. So it's something that is really important. And part of why the economy will grow is you'll have so much stimulus coming in. I just want to put, before I wrap up on the economy, I just want to put a couple of things into perspective. The first one is the amount of stimulus that's coming in around the world. And I don't know if you saw in Japan today, it was reported that the Bank of Japan is going to do unlimited amounts of bond purchases. The ECB and the Eurozone have talked about doing unlimited amounts of bond purchases. The Federal Reserve is taking their balance sheet up to what could be $10 trillion from a balance sheet that was about $3.5 trillion. So the amount of stimulus that's coming in is tremendous. And I just want to put these numbers on the page together for you because they're so important. When you take the amount of what we did is we took the employees in the U.S. and we said what industries are impacted, and we said that it's about 30 to 90% of the jobs in the country are going to be impacted. We think somewhere between a month and 6 months. Then we tried to factor in how much income is lost. And when we did this, we came up with a number about 450 billion of income that is lost. We think the number now is probably a bit bigger than that. Let's say 600 to 700 billion. The fiscal stimulus that's coming in the U.S. is over $2 trillion. Reason why I think this is such a big deal, and I want to talk about this today, is when you evaluate investments and you think about markets, the stimulus is much bigger than the income loss. What's so hard today is getting people back to work and getting the stimulus in the system. But the reason why the markets are more comfortable investing today, the reason why we're much more comfortable investing today is the stimulus is so big that it will have an impact, and we think it will have a very positive impact. So, let me skip a few pages and I'll summarize. And I'm going to skip, and y'all are welcome. I'll send you this deck. It's got a lot of sensitivities around markets, but I want to go to these last few pages. And what I show on this page on the screen is just, and I'll just touch on some of these numbers. When you take the chart on the upper left, this just shows globally the amount of stimulus that's coming in and compares it to where we were before. And the chart that the table we put on the upper right shows that if you take what the central banks are doing and what the governments around the world is doing, it's about 11% of GDP. That is a monstrously large number, and meaning that we think the global economy will come back, and we think you'll create some stability. It just takes a period of time for that to take place. So let me finish by going to my last couple of points around markets. First thing I would say on if you can see this on your screen, page 22, is there's a couple of conclusions around what's happened. The first is what we looked at interest rates around the world, the G7, Asia Pacific, Latin America, Asia, and every country in the world is cutting interest rates. And I just think this is a really important point. Interest rates are going to be low, they're going to be very low for a very long time. And part of the reason why this is what the chart I put on the bottom of this page is this just shows what's happening in the world today is people are aging, and in a way that is aging faster or aging to higher age points than we've ever seen in history. We have an older population than anything we've ever seen before. And so what we did is we took just people turning 65 years and above and their demand for assets, and that's what those bars are. But then I put that green line that shows the amount of assets available after what the central banks are buying. It means there's not enough income in the world. There's not enough bonds in the world. And the thing that I think is really important, part of what I talked about some of our funds and some of the other funds that XP manages and looks after, finding income in the global economy, finding income into portfolios for clients around the world is going to be the most important phenomena that we've ever seen. And I really think that investment. So part of what we're doing in our portfolios is how do we get income into portfolios, do it in a stable way that is consistent for clients. And anyway, that's a really big deal. I just want to spend 1 minute on the end here and talk about the equity market. I don't know. I've been doing a lot of television around the world recently and talking about the stock market. And one of the things that I think I'm going to talk about the U.S. stock market, and I use a lot of statistics here to talk about where stocks are versus interest rates. And when the Federal Reserve brings interest rates down to the level they do, or the ECB does, what naturally follows is money. What is happening is you're making interest rates less attractive, so people flow into the stock market. And I show this actually in the bottom left on this page, that what we do is we take a lag and we say what happens after the 10-year Treasury note moves down to these sorts of levels. The equity markets tend to move up dramatically. It's the same thing on the chart in the bottom middle. When the central banks put this much liquidity into the markets, the equity market tends to follow. Now, one thing I will say, which I said on TV across the world today, is I actually think some of the equity markets have actually run a lot already. In fact, the U.S. stock market, the S&P 500, is up 28% since I think it's March 25th. I think it's run up a bit too much, so I think it's going to come under a little bit more pressure. I think it can come back a little bit, and then before it rallies again. So anyway, to summarize, what I started with is, can you believe some of these things have happened? Things like supply chains in the U.S. that were outsourced for 4 decades that can actually then are now going to return to the U.S. as the economy, as countries onshore. And this is one of the things I get concerned about, is we've lived through this world of globalization and global trade, and I actually think some of that is going to become more domestic going forward. It's something that's pretty important to think through about where we're investing in the world. And then, would you believe that things like, we call it modern monetary theory, meaning you can take interest rates and just keep borrowing in almost endless amounts, and a number of people have said we should do that in an aging economy or aging demographic, but all of a sudden it happened because you had this virus and people had to do this. Things like universal basic income, and one of the things that's happening now around the world is government sending checks to people to spend money. And I actually watched this play out in the U.S. today. That's pretty incredible. But would you believe that a couple of months ago? Hard to believe. And then things like like Amazon, that is disrupting things like pharmacies, groceries, medical supplies, but now they're considered vital industries, so people can get through the virus. And then also that the price of oil, would be less than the price of a movie ticket is nothing anybody ever would have believed. So anyways, a series of things that are happening across markets, and I don't want to go on too long. I'd like to answer some of your questions. But what I show on this last page, what we're trying to do in our portfolios is I call it manage the near term while invest for the long term. So there's a lot of volatility, there's a lot of uncertainty. Make sure you're holding a lot of cash in portfolios. Make sure you're being conservative around things you do. But then when you see these opportunities that are presenting themselves, invest for the long term. So buy some of the assets that have come under pressure, that are relatively stable over the long term. Things like technology stocks or healthcare stocks, some of the consumer stocks. And then you got to be a bit careful in places like hotels or airlines, and for a period of time. So that's how we're running it, and that's how we're managing it for our clients. So I'll stop there and go in a direction that you would like.
Excellent, Rick. That was very interesting, very clear. Lots of lessons here. So I'm going to open, the Q&A with, Alberto is going to start with the questions, please.
Well, thank you, Rick, for the presentation. Very thorough presentation. I believe it was Larry Kudlow, right when the whole thing started, and I think he was on the morning show on CNBC. And Joe asked him, said, but what's the story here, Larry? Are we going to save everybody? Is this the new normal that, if you go down, et cetera, et cetera? And to me, this is something that I've been using a lot to advise our clients, because to me, the biggest difference between 2008 and 2020 is that a virus is not fair game. I mean, if your competition takes you out of business because you're better, that's okay, that's fair game. But if you have to leave the marketplace because a virus attacked you, it's just not fair game. So to me, one of the main issues, and to XP, one of the things, and we have been telling this to our clients, is one of the biggest differences that we can definitely, or not definitely, obviously nothing's definite, but perhaps there's a much lower risk in 2020, 2021 that we're going to have some type of Lehman event that will just come and destroy the market from nowhere. So I was wondering if you could perhaps go a little bit deeper on that view, whether or not BlackRock has a similar view or not quite as much as we have been telling our clients.
No, exactly the same view. 2008, there were structural issues in the system in that there was so much leverage, so much borrowing that had taken place, particularly in an irresponsible way in parts of the economy globally. And it was just more and more debt being put on. You could see it building. And then all of a sudden, that debt had to be unwound in rapid fashion. And derivative contracts had to be unwound. Housing, issues around housing globally, real estate globally. Anyway, this is, like you said, this is really different in that nobody expected this. But then what will happen on the other side of it is the economy. I showed those charts on, almost a V-shaped recovery. And it's probably not going to be perfectly V-shaped, because there is definitely some deliberate nature to when people are going to go back to work, when they go to football games, when they go to sit next to each other in movie theaters as well. So that'll take a period of time, but manufacturing will come back pretty quickly, and things that we're seeing in the consumer is happening, and so you have an economy that, not like 2008, will have this, we described second quarter down 33% quarter over quarter in the US, and then up 12%, up 11%. But even into 2021, we think you're going to see something like 5% growth in real GDP in the US. That's a pretty good number on a historic basis. And some of it is because the central banks will continue to keep interest rates low. The fiscal stimulus will continue to get into the economy. And so, you could feel pretty good about, particularly some industries, technology, pharmaceuticals, healthcare generally, some of the consumer spaces, that they'll come back. Are there some places, oil is tough, energy is difficult generally, and I would argue there's some structural dynamics there. But the broad economy globally will come back. And so, you could be comfortable making some investment. Now, should you be more conservative than otherwise today in terms of how much cash you hold alongside of it? Yes, I think so. But I think, people say, and I hear on TV all the time when I'm always on these shows, and people say, don't invest, be careful. I mean, people would have missed a 28% rally in 3 weeks. That's like 3 years that you would have missed in 3 weeks or in 2 weeks. And anyway, I do think that people should be investing, but prudently, cautiously, hold some levels of cash. But this is not like 2008. It's very different.
Great.
Ricky, thank you for the amazing presentation so far. Since most of our clients are Brazilians, would you mind sharing your thoughts about Brazil? Where do you see opportunities, and where are the main risks that you face in this current environment?
Yeah, so I'd say a couple of things about Brazil. I mean, one thing is, we've been pretty impressed. If you go, the reform agenda that took place last year, and then the disagreements between the president and Congress proved to be less relevant than feared. We are a bit disappointed with the growth outlook. The economy's growing a bit less than expected. The consumer-led recovery took place in the second half of 19, but we now expect real GDP in the was it down the 3 to 4% range, with some risk to it overall. But I think one of the things that you were describing, the administration made it clear this will be one-off. That overall. So we think there's some opportunities. Quite frankly, I will say we've been pretty pretty blown away by a couple of things. One is obviously from the monetary policy side, a big liquidity package, the bond purchase program, swap line with the Fed, continued FX interventions. But one of the things that's we've been pretty astonished by is the depreciation of the real, and that has obviously created some pressure. But we like we've been big investors in Brazil for a number of years. We are still looking at opportunities today. Like I say, from an external point of view, the currency has been something we've been a bit concerned about, and so we're being a bit careful there. We're doing things we've been doing is more on the hard currency side of the debt markets that we've been involved in Brazil. But anyway, like I say, in a similar way, there's been a lot of policy that's come to the equation, and so we think we think the investment opportunity in Brazil is also pretty significant.
Thank you.
Great. One other question that I always get, Rick, from our clients, and actually something happened yesterday, which I believe is very relevant, and I should mention it to the people that are looking at this webinar, is that Mexico was actually able to go to the market yesterday and raise something like $6 billion, which I thought was a very positive piece of news from the standpoint of where we are right now and the uncertainty that we have in terms of the possible effects that the coronavirus is going to have on U.S. industry and therefore Mexican growth, et cetera. But so I believe, and I think that this was also very positive, because López Obrador, the president of Mexico, is not a very popular guy in Wall Street. So
that's right.
So it's good news that happened. So I know there's a lot of more juice in these bonds because the coupons are much larger, et cetera. But if you were to make a recommendation to somebody that is looking at this in terms of whether or not you should have an overweight exposure on EM hard currency bonds, or perhaps be more focused on high yield US, which is also paying a very significant amount of yield, how would you approach that difficult conundrum of whether or not which one of the two is perhaps more interesting? How are you guys looking at that?
So first thing, I think you were in our strategy meetings today, because that is what we were. that is literally what we were talking about and debating. And by the way, I just echo one of the comments you made. In not only Mexico raised a lot of money, but Pemex, the state, as you know, the state oil company, was just downgraded to high yield, and it was tremendous pressure and concern around that. And then to come to the markets. And in issue in Mexico is pretty impressive. And one of the things we're seeing across markets, is I think people underestimate, if you're pricing some of these debt markets at the right price. I've never seen the amount of demand for income that we're seeing now. We broke records, I think, for 4 straight days in issuance in the U.S. in the investment grade corporate bond market, getting a couple $100 billion done one week. I mean, just immense size. When the Federal Reserve, when the ECB, when the Bank of Japan, and all the central banks drop rates down to these levels, people need the income. And so, I think the reason why I think you asked the right question is, now that a lot of these investment grade markets, things like U.S. mortgages, municipal bonds, et cetera, have moved to such low yields, people are like, I got to get yield in the portfolio. So part of why we were wrestling with this discussion today. We are quite frankly, including today, we started adding some hard currency debt in emerging markets, because some of the levels that are, we're looking at some of the hard currency debt, it was 6-7%, depending on where it was. You're looking at levels now in the U.S. for corporate bonds that are 1.5% in 5 years and in maturities, shorter than maturities. And high yield gets you similar yields depending on what sort of risk you want to take. We're erring on the side. We're running a bit more high yield than we are emerging markets. And I think the point that I think you were referring to, there are places in emerging markets that are still difficult. Places like Turkey is difficult. South Africa is difficult. Ecuador is difficult. Restructuring Argentina, obviously, difficult, and going through a restructuring. So, the reason why Mexico, Brazil, Indonesia are places that we like investing, and they're places where you can get the return, and not just in some of the country debt, but also in some of the corporate debt. So we are going there, I would say, in a ratio of about 65-35. We're doing a bit more in the U.S. high yield market, but it's the thing that is really important now in some of the characterization of U.S. high yield versus investment grade bonds is changing, because it matters more what industry you're in than it does what the rating agencies have given you based on where you were a year ago. So things like that were investment grade, the airlines are hard, the energy companies are hard, even if they're investment grade. Some of the retailing stores are hard, whereas some of the high yield businesses like cable, healthcare, technology, some of the industrials, that's where we're going, and some more industries as opposed to rating today, but on a ratio about 2/3, 1/3, more in high yield today as we're taking yield. But like you're saying, we like some of this hard currency debt in EM, but we're just being a bit cautious around where we go, more so than we have pre-virus.
Ricky, we also have another a question that you touched a little bit in the previous answer. It's always about the Brazilian real. Can you share your thoughts about it?
About the currency?
Yes, please. The currency, Brazilian real.
So, I will tell you, the hardest thing that I do in investing is, quite frankly, is currencies, because what affects the currencies is it's different than when I invest in corporate bonds or invest in mortgages or invest in emerging market debt, because so much affects the currency that is out of your control and is impacted by flows. And per what I was describing earlier, the Brazilian real has I mean, we have owned some Brazilian local rate debt, and we don't have that much exposure now, but it is the currency has. Our sense was the currency would stabilize much more so than it has, and if you said to me where I think it would go from here, gosh, we think it should be more stable, and it's one of the things. By the way, it's not just Brazil. A lot of the emerging market currencies are really difficult today, and as whether it's flows, global flows, trade flows, or concern about the virus, and how in some of the emerging countries it can take a bit longer. So we're being a bit cautious, but it is so hard to say, should it stabilize? I think so. But it pays to be a bit cautious today. I mean, it's just, you could follow the technicals in most of the markets pretty carefully, and the fundamentals. Currencies are hard, and oftentimes it's not just the local currency. It's it tends to be when emerging market currencies tend to come under pressure or the dollar is rallying, then it's just more difficult to predict it.
Okay, Rick, let me jump here with another question. You touched also during your presentation about the packages from the government, and all the money that's been flowing into the economy. What are the odds that you can actually that this may not work, and we end up with a huge inflation issue, and then the value of money is not the same as we are used to now. This was actually a topic in a recent live we did with a local portfolio manager. We talked a lot about the value of money as we know today.
So the questions aren't getting easier. Listen, there is, I've been one of the most famous investors who I'm very close with. We spoke on a panel the other day, and he said, "Where do you think we're going to be in a few years?" And he said, "I don't know. I just got to figure out the next year." And and it is. Listen, I do think there is a real risk that all of this money being thrown at it is, and all the debt that's being grown is going to create an inflationary problem. So one of the things we like in our, talking about our global allocation fund, we have a 5% weighting to gold, and we like that for exactly the scenario you described. We are also long inflation protection through we bought a lot today, as a matter of fact, through these tips and break-evens or linkers in different parts of the world, inflation linkers in different parts of the world. I do think it's going to be I would say, part of what I think can create that is I think there are parts of the world where I don't know how the math can work, particularly Japan, particularly Europe, that there aren't more and more debts going on. I look at places like Italy, and more debts going on, and the central banks, the ECB, the Bank of Japan, are willing to hold rates down and buy all the debt. And then at some point, unless you get nominal growth high enough, then you can't offset that debt and you can't pay back that debt. And the only thing that can happen is you have to functionally tear up the debt and then take the pressure in your currency and create an inflationary dynamic. Listen, I don't think that's a 2020 problem. I don't think it's a 2021 problem, probably. But boy, I think longer term, I think it's, part of why I like gold in a portfolio, just put it away. And I do think that could be an issue longer term. And I don't think anybody can tell you with certainty that won't be the case. I am more constructive that places like China, where I do think there is real growth that will take place over the years that can reduce their leverage. I think the U.S. can do it with the right policy. But boy, this is. I think policymakers are doing the right thing because many have described that there's a war going on against this invisible enemy, and you have to try and get through this because you'll destroy businesses and structures and financial institutions if it's not solved. And that's why I was talking about earlier, that stimulus, it's so big. But then, there has to be the right policy to try and bring down the debt on the other side of it. And, I worry that that's hard in some regions of the world. And, I think it's, first of all, it's hard investing for 2022, 23, but I think there is a real risk by the way, I think there's a near-term risk. There's more deflationary factors. We were looking at a lot of the corporate earnings today, and as you would imagine, companies have built inventory, whether it's automobiles or general retailers and apparel, and so companies are bringing down their prices to try and clear their inventory, and so there's a near-term negative inflation, and so part of why we like buying inflation protection now is you're buying it so cheap because of this near-term set of factors. But longer term, I for the first time, I will say, literally, I've been a big believer that because of technology, you don't get that much inflation because an aging population, you don't create enough potential growth that people keep talking about inflation's coming, and I just don't think it's going to be coming. But now, for the first time, like you say, because of the debt, I could see it, but not. I was asked today in an event in Switzerland, virtually, that do you think it's double-digit inflation in many parts of the world? And I don't think it's double-digit, but I do think that you could see something in the significantly higher than we've had. In the mid to high single digits in a lot of the developed world for going out a couple, 3 years from now.
Great stuff, Rick. I actually agree 100% with you in terms of the linkers. It's a pretty logical investment theme.
I think so.
One thing that I keep on my job again is to worry about things, and I am becoming a little bit worried about the pushback from the population at large with something that I don't believe the population understands, but sounds very catchy, which is you can't do equity buybacks, right? So and I if we look at the performance of markets in the last 8-10 years, buybacks were a very important component of that, and unfortunately people don't get it. I mean, buybacks are the base of capitalism, because you can use, if you're not being able to use that money in your company with a high enough rate of return, just give it back to the investor, to the capital holder. That makes perfect sense. But it's very hard for somebody looking at this that doesn't really understand economics and finance, and politicians are going to use that. So I'm getting a little bit complicated. I'm concerned about that. Are you guys giving some thought about what the effect of that may be, let's say in 2-3 years time, in terms of how capital is allocated because of the help that the government is giving all these companies?
Yeah, so it's a great question. I was asked by a policymaker yesterday about that. So there's also dividends. There's a long discussion as well about dividend payments, and I will say, I think, at least for the time being, that there's a big discussion about should companies be paying out dividends, and for example, financial institutions should be paying out dividends when there's concern about loan losses, et cetera. I think for the near term, and you can't say this with certainty, and there are parts, for example, in Europe where they may pull back or prevent some dividends for a period of time. But I think dividends generally are not going to be touched. And I know conversations that I'm sure many I've had with policymakers about how dividends are relied on for income for people and pension funds, and companies pay dividends for 100 years, and you should let that continue. But the buyback one, like you say, is more controversial. And because buybacks have had two big effects. In fact, I study obviously in the U.S. markets. The number one buyer of equities in the last few years has been corporations buying back their own stock, and it's had two effects. One, it's certainly helped drive the stock market higher, but it's also helped their earnings, like you were saying. The way they've been able to drive return on equity and earnings per share is by the equity buybacks, and to not allow that to happen. To make generalizations that from policymakers that you can't do that. Like you say, if companies don't have good capital expenditure things to do or build inventory, then they should buy back their stock, and that's exactly the way capitalism is set up. But I think it could, depending on the extent of this virus, depending on, like I said, I think some European, I've seen that out of France and some other countries, there could be some pressure. Certainly, any companies that need bailout money, airlines, potentially hotels, et cetera, those are going to have a hard time buying back their stock for a period of time. But I'm with you in that I don't think policymakers, there's been a series of proposals, people I know that have said that hiring should be linked to equity buybacks. And listen, I think companies, as long as they're socially responsible, should have the flexibility to manage their business within their industry that is the most appropriate, as long as they're being socially responsible. And I think for policymakers to make broad statements like that can have real disruptions to markets and financing when you say, okay, you can't do this tool, you can't do that tool. So I'm hoping, I think like you are, that should not be pursued unless the company is being bailed out in some way, and then I'm respectful of that.
Ricky, what's your view on the distressed markets? Do you see opportunities even in an environment that the U.S. central bank has been providing a huge liquidity?
I do. In fact, that is part of what I was describing in terms of being cautious in the markets. In fact, in an almost unusual way, that we're seeing a lot of these restructurings take place where companies need to restructure I could say this, we participated in this company, Airbnb, that did, it's good business, good cash flow. And when they restructure secure assets or get liquidity, and they're willing to provide collateral and covenants in terms of where the cash flow gets to, that you're senior in the waterfall on cash flow, I actually think that's some of the best opportunity today. And so we've been involved. I don't know if you've heard a lot of these REIT companies that have been unwinding or looking for financing, but this is, for distressed investing. This is one of the best periods of time, and it's a win-win. I mean, obviously, companies need the money to get to the other side, and things like aircraft finance, where companies need the financing. I think that's some of the best opportunity in the markets today, particularly, as we were talking about earlier, with the central banks, like the Fed, pulling a lot of the high quality assets close to zero. You can feel pretty good about, what would necessarily be called distress, but where you're getting collateral, covenants, real structure, and make some good investments. So we've been doing a fair amount of that in the portfolios that where we have the flexibility to do it. And I think that's one of the best opportunities in the market right now. And by the way, also in some of the emerging markets that are, where countries are going to restructure, or their corporates within it are going to restructure. We're running, part of what I was saying, we're running a lot of, heavy levels of cash in our portfolios. Is, these opportunities aren't going away in April. We think there's more to come, and I think it's one of the best for the rest of this year. I think this is going to be one of the best opportunities to take advantage of. And like I say, helping these businesses, just to continue to operate. And so I know that's a place we're looking to invest more so.
Thank you.
Thank you so much, Rick. Well, we could stay here for another hour asking questions, guys. But we are approaching, almost a full hour of your time. And maybe last few minutes, just share, we surpassed 1,500 people in the audience. And, as we explained before, most of the audience is, investors and people that just get interest, in the markets. And so maybe some last words for the audience, a final message, from you and from BlackRock, how you see, we already, talked a lot about, your views, but just a final message for the audience that's here with us, and I would like to understand better your views.
I mean, the last thing I will say is, this is, I do a lot of work. I have a lot of school programs in a lot of the underprivileged areas in if you know, Newark, New Jersey, or Atlanta, Georgia, and I don't know why this is one of the most. Since I've been around and working with a lot of policymakers and people in Congress, this is one of the hardest periods for people that I've ever been around, let alone the healthcare dynamics around it. And I hope everybody on the call is doing okay. But anyway, this has been one of the most toughest periods I've ever been around, away from the markets. And I hope it's getting to the other side is going to be hard, and it's going to take a while. And I think it'll take longer than people think to bring a lot of businesses back to the way they were. That being said, this is so different than 2008. And if I could say one thing, I know the chairman of the Federal Reserve talked to Ben Bernanke, who went through 2008, and he said to him, what mistake did you make, or what would you have done over in 2008? And he said to him, I would have been bigger and faster. And that's what, and that lesson has been learned, and the policymakers to try and address these issues are being bigger and faster, and that means that the recovery will be faster, and some of that the heartache that we're dealing with now, is going to be easier than it otherwise would. So, one thing I say, I hear when I go on TV a lot, and I'm in these panels, and people say, don't, be careful, don't do anything. That's not the right answer either. And I think being cautious, being conservative around cash, being conservative around, what the uncertainty should suggest around where how businesses reopen, et cetera, is important. But I also think people should, people are going to need income, and looking at places to get income, looking at places to generate return, this is also an opportunity, to be a good investor, and that good investing helps a lot of businesses survive and grow. So I do think that just sitting out and not doing anything is not the right thing, as I hear a lot of people on the media talk about. So anyway, I'll leave it there if that's okay.
No, that was perfect. So I'd like to thank you again on name of myself, Alberto, Thiago, XP. XP is very we are very honored to distribute one of BlackRock's funds. I thought it was. Thanks again. Be safe, and
you too.
Yeah, have a good night.
Thank you. Thanks for your time. Thank you, everybody.
Thank you very much, Rick.
Thank you, Ricky.
Bye.
Bye.